Welcome everyone. Today we're going to be talking about divergence and convergence. So, what is a divergence? A divergence is when an economic performance or conditions begin to move apart from each other. Similar to this little graph where, let's say, one economy is increasing in value or getting better, whereas the other one is starting to slowly decrease. That's a divergence. Think about it like the gap is getting wider and wider and wider. This move can occur through different avenues within the economy. You could be comparing GDP numbers, you can keep comparing inflation numbers, monetary policy, etc. to get a good idea of who's diverging from the other. You would rather be long the currency who's experiencing positive moves and sell the currency who's experiencing moves lower in their data. And that's when you see really big trending markets, when there's a clear divergence between, let's say, what the Fed is saying versus the ECB, or the ECB versus the Swiss National Bank. That's an example of a divergence forming. Could be comparing inflation numbers, which then obviously ties into monetary policy, of course. So there's multiple ways of looking at divergences. What you want to be focused on is what is the theme of the market, and that will give you an idea of what divergences in terms of the data or the themes you want to be looking at, which you'll learn in later videos, of course. So what is a convergence? So simply, it's just the opposite of what a divergence is. It's when economic conditions are more or less similar to each other. Your approach will be that similar to divergence. However, it is a lot more difficult to trade these environments as there is no divergence and no clear narrative within the FX pair. For example, if you look at dollar CAD, USD CAD, during around 2022, go onto your chart, go on the daily time frame, and you'll see dollar CAD was moving ever so slightly higher, but it's very choppy. And that's because we both had the Fed hiking interest rates. Their data was really, really good. Whereas, we also had the Bank of Canada raising interest rates, and their data was also really good. So the market's really choppy during that period. You can either leave the pair alone and move on to a pair that has divergence, or you want to be finding an edge within the converging currency. And what we mean by that is the example we gave down there. Is oil prices rising, and that's going to be potentially bad for X currency in the short term? Is the market risk on or risk off, for example? If the markets are risk on, i.e. they want to be taking on a little bit more risk, they're happy with the environment, and you're buying, let's say, a risk on currency like the Australian dollar. Let's say the Australia's economy and the Swiss's economy is similar. Well, the Swiss franc is a risk off currency, which you've learned in the videos, of course. And the Australian dollar is a risk-on currency. Although they might be both similar in terms of their data and what both central banks are saying, what the governments are doing, etc., you might want to rather be long the Australian dollar in that environment because of the risk-on environment. So you just want to be finding the edge, having a little bit of thought about what is happening in the world at the moment. What's this going to mean for X currency over here? What does it mean over here? That's an edge in the market for you. But like I mentioned, you can either just leave the pair alone. There's going to be no argument against that. Or you can find an edge and might take a bit more of a broader range of what's happening in the markets, of course. So how do you trade divergences? So there's a couple of ways to trade economic divergences. A common way would be to look at central bank rhetoric, i.e. who's more hawkish than the other. As you've learned in the monetary policy video, the currency tends to strengthen when the central bank is hawkish and sell off when the central bank is dovish. A live example, i.e., as of right now, at the time that we're recording this, which is in 2024, of course, selling the Swiss due to the SNB or the Swiss National Bank is cutting interest rates, whereas the central banks like the Bank of England or the Fed are still looking to keep conditions tight. In this environment, pound Swissy or GBP Swiss and USD Swiss or US dollar Swissy have risen massively since the start of 2024. There are multiple ways to trade divergences, but remember to think about the theme of the market, which you will later understand in further videos. If the market cares about inflation, then you compare inflationary data to have a better idea of where their focus will be. If they don't react, i.e. if the markets don't react to trade balance data, then it's not a viable way of trading that divergence. What we mean by that is the markets care about inflation at the moment, so what we want to be focused on is inflationary data. So if inflationary data in, let's say, the Swiss, which it has been trending lower recently, whereas the inflation in the US has stagnated or sort of started to bottom out slightly and similar to the UK as well, then you'd rather be trading that and say, okay, at that point there, maybe this central bank is likely to be a bit more hawkish, whereas the Swiss is dovish. That's a clear divergence there, and therefore that's a viable way. But if you're going to say, okay, I'm going to trade this because the trade balance in this economy is doing this, trade balances in that economy is divergent there, and you trade it, that, in my opinion, and in our opinion, is not a viable way because the markets do not care about that. They're not even going to look at that. So this is why we always have to just follow what the markets care about, because again, we're not going to be able to move the markets, right? So we need to follow who moves the markets. What do they care about? And therefore, we must care about that as well. So trading divergence here is just pound Swissy on the left and US dollar Swissy on the right. So as you can see with pound Swissy, since the start of the year, we came from really strong Swissy to then around this period, I believe it was, when the S&B was talking about they don't want a strong Swissy anymore. But then saw a bit of a pullback, which is fine. And then long, because at that point there, Bank of England was still pretty hawkish. NCB was more and more dovish. They then cut interest rates, bang, and then the currency just weakened further and further and further. Similar to the dollar, of course. Dollar came into 2024 really weak because we had really weak data, etc. We saw a massive rebound in the US data. S&B was really dovish still. Bang, bang, bang. They cut interest rates and the Swissy just continued to weaken. So what we want to be focused on is the data in Swissy or in Switzerland continuing to diverge that against the pound or against the dollar in this example, or against the Australian dollar or against the euro and Europe. If that is occurring, then you know you still want to be long pound Swissy or dollar Swissy, for example. So that's a live example of just trading divergences. So how do you trade a convergence? A convergence trade requires a little more caution. This is because if both economies are strong or weak, you tend to be a bit more choppy price action. You want to be able to find the edge in the trade. But if you'd rather not trade a convergent trade, that is also okay. Trading divergences is a much better idea. An edge in the market could be something like oil prices rising, which will benefit an economy like Canada as they export a lot, and hurt an importing country like Europe. In this environment, you would expect to see EuroCAD sell off tactically. Maybe not like massively fundamentally, but more of a tactical sort of short-term play, which you will learn about tacticals and sort of longer-term plays in later videos. You can trade the initial start of the convergence, i.e. a country could be outperforming well and then suddenly start to slow down. You can initially trade the slowdown, but don't expect a trending market. See it as a high time frame pullback. What we mean by that is, let's say pound Swissy is, let's use the live pound Swissy example. UK at the moment is still pretty good. You know, Bank of England is still pretty hawkish, and you know they're looking to keep rates higher for longer than against the S&B. If suddenly the UK now starts to see massively lower inflation, wage growth is coming in much lower, therefore you could logically state that at the next meeting the Bank of England is going to be pretty dovish. You're likely to see the pound weaker in that environment. Maybe not massively weaker, as we said, don't expect it to be like a massive trend on the higher time frame. Think about it, if I just go back slightly, think about it like a higher time frame pullback. And then that period there, we can reevaluate kind of what's the data saying and then say, okay, we want to go back long to this pound Swissy, for example. So what you want to be doing is not say, oh, now we're going to trend lower and lower. What you're saying is view it as a high time frame pullback to then potentially go long again if the data warrants it. So that's when you could tactically trade it, wait for some breaker structures in the lower time frame, wait for the pullback, sell it into whatever region you deem fit, of course. So that's just an example of trading the initial convergence, if you want to trade that, of course. So that is simply how you trade divergences. As you see anyway, it's much better and much easier to trade a divergence than it is a convergence. A convergence requires a little bit more thought process, a little bit more risky as well. So it just depends on your risk tolerance. It's completely up to you. There is no right or wrong answer here. It's completely personal. So that is divergences and convergences. We'll see you in the next video.